What's going on, everyone? Welcome to the 6th episode of the Crossroads, a weekly financial show for our generation.
And welcome to everybody listening over on the long game. We appreciate you tuning in this week. This week's episode, we are going to be talking about why investing is not gambling. I think that the reason why this is such a popular topic and something that we want to talk about is just the way that investing has changed over the years. So with the creation of Robinhood and, just all of us having access to investing, it's really changed investors' behavior from holding for long term, buying individual securities, sticking with them, to now we have 14-year-olds who are on Robinhood actively trying to day trade. Really small companies that are really risky. So we just wanted to dive in today and talk about the differences of gambling and investing. And so, Trayton, what do you really think about this topic?
Yeah, I think like the biggest difference between investing and gambling is, well, it's important to note that like any investments are going to carry risk just like gambling does. But I like to think about it like kind of like the time horizon and like the purpose of what you're investing in and what you're doing. Like with gambling, the longer you play, the more likely you are to lose money. And then when you're investing, it's like the longer that you stay invested, the greater chance you have to make money, which is the complete opposite of gambling. And I think you had like a really great graphic that kind of broke that down.
Yeah, I think that it's funny because uh, gambling is that way. So like you go play blackjack, your chance of winning one hand or roulette is basically like close to 50-50. It's a little bit less than that. Um, but then the next time you play, it gets lower and lower and lower that you're going to end up like above and win money. And the research says from Wall Street Journal that 13.5% of gamblers end up winning in the long term. So statistically, you're not really going to end up making money from gambling. So I think the big distinction here is like gambling is fine. Like the goal of gambling though should be I'm doing this for fun. I have a set dollar amount I'm going to use. I'm going to go with my friends and I'm going to play some games and it's going to be entertainment. So then if you lose money, well basically that's just money that you were spending on entertainment. But then if you look at the research on investing, it's completely different. So you said that every year it kind of goes up. So what the research says is in a 1 year time horizon, your odds of being on top in investing are 68%. Honestly, if you think about that's a pretty good number.
Yeah, that's not bad.
There's still risk. There's still risk involved. Obviously, there's going to be years where you're going to be down, but 68% of the time you're going to end up above. Okay, so then a 3 year time frame, 79%. 10 year time frame, 87%. 15 year time frame, 94%. And then 25 years is 100% of the time you end up on top. And so I think that is really the big distinction, is just understanding that gambling is just a short-term game meant for entertainment. The odds that you truly make money in the long term are really low. But the odds of making money in the market are pretty high when you increase your time frame. So for the millennials, all the people just like us who are getting started in investing, our time horizon for most things, especially retirement, is 40 years. 30 to 40 years. Your odds of ending up positive in that time frame are 100%. So I feel like that the thing about this is it should help people understand that if you invest, like there are risks to it, but the longer the time horizon you have, the less risk there really is to end up on top.
Exactly. And I think kind of like visualizing that is when you're investing in the companies and you're investing in kind of like their balance sheets and like their competitive advantages and everything if you're like truly investing. But when most people are day trading, which is what's commonly correlated to gambling, like you're kind of just trading off the latest price swings and just news and things like that, and that's not like truly investing. But if like a common investment's just like the stock market as a whole, like you're investing in the odds that the stock market is going to keep going up over the long term, and just kind of based off that study from the Wall Street Journal, that's exactly what happens. But if you're to pick just individual companies, like a few every month, like that's a little bit closer to gambling because you're trying to time the market and pick what's going to go up more than the market, and that requires a lot higher risk, and that's why some people consider like the stock market gambling, but that's usually more related to day trading.
Yeah, that is a really good point. The research is based off of like a broad-based investment portfolio. It's not based on, hey, if you pick three small tech companies that after a 25-year time horizon, 100% of the time you're going to end up on top, because like the less diversified you are, so that broad-based portfolio is really diversified, you're betting on the market doing well. And so the belief is, and I got this from Morgan Housel, is if you're an optimist and if you believe 20 years from now the world's going to be better than it is today, the economy is going to be running better, there's going to be better businesses, there's going to be innovation, well then your belief really is that the stock market's going to be up in that time period because you believe in a better future. I guess the flip side of that is if you're a pessimist and you think this is the best the USA is ever going to be and the world's ever going to be and we're just on this steady decline, well then I guess I could see how you would be scared to invest. But I agree. I think that is a really good distinction.
Yeah, and like slightly off topic, I mean, that's kind of where people are starting to invest in cryptocurrency and like DeFi things, is because they're like, I don't know if the US is going to get better and like the stock market's going to keep going up over time and the economy's going to stay strong. And that's also just a reason like why some people are starting to put allocations toward crypto.
And really you can do both simultaneously. So I think that there's almost a misconception today that you're either 100% in on crypto or you're like, I'm going to stick with the stock market. But true diversification is mixing money across different asset classes. And crypto is an asset class that is starting to exist. It's one that if you're interested in it, if you believe in it, it's something to explore and consider investing in. And like for both of us, it's a part of our portfolio because we can see still the good of the future of the economy, but we can also see how the technology and the innovation in crypto is going to help further the advancement in our economies.
100%. And I don't know if you had anything else to add to that.
I think just the key takeaways in what I've talked about in this blog post is one, that investing is not gambling. I think for people that are pretty uneducated on investing, they use the words interchange, like they interchange those two words and say, "Oh, I'm gambling on the stock market," and that's just really not true unless you are the person who's actively day trading and trying to find discrepancies in the market, which is pretty hard to do today. The second one is the longer you stay invested, the higher your odds of making money are. We went through the graphic. That's true. Next one is in gambling, the house always has the higher odds. So you're really not likely to make money when your chances are always less than 50%, versus investing, the odds are really in your favor just based on bull markets. The length of a bull market is 6 to 8 years on average, and then the length of a bear market is about 2 years. So I know I'm like off by a little bit there, but still you can tell it's way different. So the odds are that you're going to make money in the long run. And then really just the goal is to stick to your investment plan. I think too many people have an investment thesis. They think they know what they're doing, and then they nonstop are changing it instead of really finding something you believe in, sticking with it for the long term, and trusting the odds. And then the last one is just gambling is for fun. Nobody's telling you shouldn't gamble. If you want to have fun, do it. But you just don't want to go in with the mindset like this is how I'm going to, afford my future by gambling on anything, sports, blackjack, whatever game it is. But yeah, that's really all I had to add there. So what's our reader submitted question for today?
We got how to save for short-term goals, and I really like this topic because it's something I kind of just went through within the past couple of years with starting a business and everything. And I mean, the first step is figuring out what your goals are and how to save for that. Like, kind of like if your goal is to start a business, like do some research and figure out how much that business might cost when you're getting started, and also determine, like, if it is a business, how much runway you're going to need to not be able to take income out of the business when you're just getting started, because it's probably not going to be profitable right away. So you also kind of need to plan for flexibility in that as well. And then kind of once you have that amount, like let's just say it's $12,000 and you wanted to start it in 2 years, well then you can start to work backwards on, okay, if I need to hit $12,000 in savings in 2 years, I need to be saving about $500 a month to reach that amount. And then a lot of people like sometimes think that you need to put all your excess money in the stock market, but if you're saving for short-term goals, you never know what the market's going to do. It could go down, you might not have that savings amount when you actually need it. So I generally recommend like putting it in a high yield savings account. And going back to the previous part, once you know how much you can or how much you need to be saving per month, you can just set up automatic transfers to that savings account, so you don't even have to think about it. Like, you could do it twice a month if you get paid bi-weekly, or once a month, and just whatever that amount is, then set that automatic transfer. It comes out every month. You don't even have to think about it. And that personally like really helped me with the savings. Like, if I didn't have that automated transfer, I wouldn't remember every payday to transfer that money. So that's kind of how I think about it when you first get started.
Yeah, I think that those are all really good points. And what I've found is that most clients or most young professionals that come into me, they don't have set savings for different things. So a lot of people just have a checking account and they have 20, 30, $40,000 in it. Some of them have a checking and a savings, and they kind of have a mixed amount of money between the two. But almost nobody who I have met with has really set aside money for individual goals. And so with financial planning is what do we want to accomplish? So let's say in the next 3 years, we want to travel at $5,000 every year. We want to have $3,000 of housing projects. And then in 4 years, we're going to have put $10,000 down for a car that we want. Okay, well then the next steps are exactly what you talked about in this business owner case. What is the amount that I'm going to need to save every month to accomplish those goals? Figure out what that number is, automate it. But the problem that I see many people have is we have all of these goals that we want to accomplish, but then we also have to pay off debt. We also have to build our emergency fund. We still want to, take the 401k match and do other things. And they end up realizing, well, we don't actually have enough money to do all of these things. And it's not a fun problem to face, but it's a problem that every single person faces. Like, the truth is we can't pay for everything we want. We can't do everything that we want. And so I think this step is really huge, to go through this, see that you can't accomplish all of them, and then go back and say, well, what really is most important to me? Okay, well, travel is most important to me, and we want to do the housing projects because it gives us more value. So we're going to push out the car a couple years so we can accomplish that goal. And I think that's just a really important step, to figure out what you value, figure out which ones you can afford, attack those ones first. And then if you have to change some of the other goals, well, that's just kind of life, but do the ones that you value most. But I do think the point
Yeah.
of the high yield savings account is great. The automation's there. All of us forget to save. We forget, it's time, how much we're supposed to do. So just let the system do it for you. That's the benefit of it.
Yeah, I think that's a great point you made with, like, it's almost an exercise to figure out what you truly want to do with your money. And I always like revert back to the example of, like, your parents probably said that like saving money is important throughout your childhood. And if your parents are telling you to save money, like, that's probably just not going to resonate too much. Like, you want to kind of know the why behind it. And by creating like tangible goals with your stuff, like Thomas was talking with the travel, then it's like, okay, if I save this $200 every month, I know I'm going to get to go to Bora Bora in 2 years. Like, then that kind of creates an incentive. Like, yeah, I almost want to save this money because I want to go on this thing. And by creating and like going through the exercise of figuring out what's important to you and what actually matters, I don't I don't know if it's necessarily fun, but saving kind of becomes like a game at that point. It's like, well, can I maybe reach this goal a little bit quicker if I cut spending in another area, or just anything like that. Like, I think creating like a tangible, like true meaning behind it just makes it that much easier to start saving and actually sticking with it.
Yeah, agreed. I feel like, you tell people, hey, you should save $1,500 a month, and they're like, oh, I don't really want to cut spending to do that. But then if you show that $1,500 a month will let you retire 5 years earlier, it'll let you travel every single year, and it'll put you on pace to get the house that you want, well, then I'll probably find room to cut my spending, knowing that it's going to help me accomplish the three things that are most important to me. And I totally agree. That's why it's an important step that everybody should do.
For sure. And I don't really have much else to add to that. I don't know if you had anything else.
No, no, I think that's good. So, well, thank you everybody for listening for another episode of The Long Game and Crossroads. We'll be back next week, and don't forget to subscribe and like. Thank you.